Good morning and welcome to the CT UK High Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the top right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to David Moss. Good morning, sir.
Good morning and good morning to everyone. It's probably a bit late, but I'll still wish you all a happy new year. It's certainly the first time any of you will have heard from me in 2026. Again, as I said, thank you for your time this morning. We'll move forward. So we're going to talk today about CT High Income Trust. Quick agenda here. What do you get? Those of you who have seen me present before will be used to the running order. I'm used to many of the slides. Start off with characteristics, bit on performance for last year, what, if anything, we've done different over the last 12 months, and into a little bit about our top positions. We have some stock examples, which we'll probably talk through anyway as we go through the first part. And then what are we thinking about looking forward? And of course, we look forward to some lots of questions from you all at the end. So let's move forward through the presentation. So what is CT UK High Income Trust PLC? And what do you get, more important, as an investor when you invest in the trust? As I said, this is a slide you may have seen before, but I'll go through it again just for those who perhaps are new to the trust. So it's a high conviction. What does that mean? 35 to 45 stocks. We want to make sure that we understand and we know every company in our portfolio. We know why they're there. The top 10 holdings represent typically around 40% of the net assets. So for the big holdings, we want to make sure that we're backing them to drive the returns we expect for our clients. We're looking for a high level of income and the prospect of capital growth. Why do I make that point? Well, first and foremost, as it says on the tin, this is a high income trust. Our aim is to deliver a high and growing level of income for our shareholders. And that's our first priority. However, we believe that we can also give, over the longer run, capital growth and provide capital growth for our shareholders, because we're not buying just businesses that happen to have high yields aren't growing. We believe we're buying good quality businesses that have a ability to pay income now, but that income can grow into the future. And with that growth in income comes growth in the share price as well. As I said, income's a priority, but we strongly believe that capital growth is a potential as well. And I think we can see that in performance over the last number of years. As I said there, we focus on companies that can grow income, because simply, if we can find companies that pay a high level of income now and see that growing into the future, then that gives us that growth in income and the prospect of capital growth I talked about. We're happy to be contrarian. We won't buy businesses just because they're large. We do look at the benchmark. We are measured partly relative to that benchmark, but it doesn't drive what we do. Simplistically, we want to buy the best quality business models, but that's best quality based on our understanding and our research and our interrogation of the company. Businesses may well be out of favor at initiation. In fact, we like to do that. That means we're often buying businesses better valuations we might otherwise. Often that comes therefore with higher dividend yields as well, which is clearly important for us. Within Columbia Threadneedle, we have a very well-established, large UK investment team that has a focus on income portfolios across the team. So there's a lot of support there, a lot of experienced investors looking for the same types of stock. That means we get lots of opportunities. It means we get lots of meetings, and it also drives great debate across the team. One of the key characteristics that's slightly different about the trust is we do have the opportunity to have up to 10% of the portfolio invested in European stocks. This means we can perhaps own business models that complement the trust, that maybe in areas that we cannot access so much in the UK. The one area that always comes out when people talk about deficits in the UK is exposed to technology. There are a lot of technology stocks in Europe we can invest if we believe they add value to the portfolio. At the moment, and really for the last 12, 18 months, our view has been that the valuation and the opportunity set in the UK is so strong, we don't have that much exposure to Europe, but it's there for us when we see opportunities. As an investment trust, we have the opportunity to use leverage to increase our return to our shareholders, and we look to take advantage of that on a structural basis. We're not making market calls. We believe that leverage gives us the opportunity to buy more of the better business with higher dividend yields. This is a slide really from the annual report, and it shows you that we've grown the dividend year by year since 2015. I think we're now in the 14th continuous year of dividend increase. Obviously, we're midway through our financial year at the moment, which ends in March. So all we can say here is a statement the board has made, which is they currently intend to pay a dividend of 5.79% for the year, which would be a 3% growth this year, if that's what we pay. And the current share price, that's a yield of around about 5%. Still attractive relative to any other source of income, we believe. We have some information here again from the annual report. For anyone who saw me present before, we would have the two columns on the right, which are directly from the annual report. And we've added in the 9 months to the 31st of December as well. So I talked earlier about prospect capital growth, and we can see that's coming through there. And you can see the dividend that we paid over the last number of years there as well. Looking a bit more at performance, we had a pretty good end to the year. So 7.4% return in the last 3 months. This is NAV returns. Clearly, the returns to the share price may be different, but we want to show NAV because that's the consistent metric that we can offer to you and show you. Over the year itself, 23.4%, so strong capital growth. And I think it's fair to say that in a market where stocks are very strong, it's often harder for income funds to do well because our focus is on income, not sort of high growth companies that really aren't paying very much. So slightly behind there on the year, but we believe that's a strong performance. As I said, we've delivered high levels of income as well. And you can see the 3-year number as well is now nicely ahead. The 5-year, which I have talked about in the past, is pre the period when I was running the portfolio. We're still some way behind, but obviously we're catching up as we move forward. The next slide looks at discrete years. So 2025, I've talked a little bit about there, but you can see now since I took over running the portfolio in 2023, we've seen better performance, and we've got good numbers now 2023, good numbers 2024, slightly behind last year, but in a very strong market. And we believe we're building that strong track record of good returns in addition to the high level of income that we're clearly paying as well. So we're very pleased with the performance we've delivered over the last 3 years. Clearly, what we need to do is keep delivering that for you into the future. So what have we done differently this year? Well, when I say this year, obviously that's 2025 now, not 2026. The answer really is not much. I would have mentioned this again in the past when we took the portfolio over in 2023. We did a lot of changes. We think to position it the right way going forward. There's still turnover in the portfolio. We'll still take advantage of moves in markets, both on the upside and the downside, to either add opportunities or add income. But we're still fundamentally looking to invest in good business models where we think these companies have a long-term competitive advantage. And that's very important because it's that long-term competitive advantage, the long-term competitive edge, that means we can be confident these businesses can carry on producing profits, paying out dividends, but as I said at the outset, more importantly, show growth in those dividends and growth in that income in the future so we can continue growing the dividend that we pay to our shareholders. The portfolio is still concentrated, 45 names, so the upper end of that range, but it won't go any more than that because we think that's an appropriate number that gives us enough diversification of opportunities, but forces us to concentrate on the best quality companies that we can invest in. We continue to hold European stocks. As I mentioned at the moment, we see the opportunity set in the UK is very large. So our European exposure is limited to 2 holdings. And they're both in that technology space. So as I said, we struggle to access to the same extent in the UK. Mid and small caps remain an important part of our portfolio. I said earlier, we're relatively agnostic to the benchmark. We think and believe quite strongly, but looking at good quality mid and small caps, we can actually differentiate ourselves relative to our peers, but also add a lot of value for our shareholders. And we will not invest in any stock purely for size, yield, or benchmark position. Clearly, yield is important to us, and yield, the dividend yield that the company pays, is a measure of valuation, and a high yield indicates a cheap stock. But if we don't see the fundamental characteristics in those stocks, we won't buy it because of the high yield. Importantly, the dividend income we generated last year by our investee companies more than covered the dividend we paid, which grew last year as well. So we've added back to reserves. So we've restored reserves into the future in case anything happens. Obviously, one of the benefits of investment trusts is we can carry on paying dividends in difficult years. For example, during COVID, when many companies were forced to cut dividends, we're able to carry paying the dividends. And the reserves are an important sign of the strength, the ability to do that in the future. So we've added back, as I said, to reserves. We have slightly looked to add some more businesses with a near-term focus is growth rather than income. Again, the investee companies we have are generating sufficient income to more than cover the dividend, and we want to offer the prospect of growth as well. So we've looked a little bit more at businesses such as Next, the UK retailer. Everyone knows it in the UK, but also it's grown very strongly internationally. Prudential, actually not Prudential. Prudential now is basically an Asian-focused life insurer, growing very quickly, particularly in Hong Kong, China, and areas around there. Weir Group, which is a supplier of services to the mining industry, again showing lots of growth. These are all lower dividend companies, still pay dividends, but enabled us to add a bit more prospective growth to the portfolio. And this indicates that last year's AGM stock turnover has been lower. Turnover to us is an outcome, not an input. So we won't just restrict ourselves because we have a mantra of low turnover. But when we get things right, we expect turnover to be lower. At the same time, as I said earlier, we will continue to always look for opportunities in the portfolio to add returns and add income where possible. A little bit more on performance. So let's talk a bit about what has worked, and importantly, we should always talk about what hasn't worked in the last 12 months. Where you see numbers in active weight in red, that's where we don't own the stocks. So, for example, the biggest positive contributor to performance last year was actually not owning Diageo, where the business of famously owner of Smurfit and Guinness has had a very poor time, as have most spirits and beverages companies. It's definitively a sign of less alcohol consumption. Whether that's the input of weight loss drugs, we're not entirely sure. Whether it's the input of weak consumer confidence, that's certainly true, but that's been a weak place to be. In terms of things we own, interesting, I'll highlight here OSB Group, Phoenix Holdings, and M&G as a starting point. These are all financials where when we purchased them, I think they all had dividend yields at over 8%. Often a dividend yield of 8% would indicate the market thinks probably that dividend is not sustainable, that maybe there's something not working in the business. Going back to my earlier point, it's always about the work we do, the meetings we have with management, and our analysis. Our analysis, actually, all these businesses are in very strong positions. OSB is a specialist buy-to-let lender. Phoenix Holdings and M&G are two insurance companies. In those two latter cases, we see very high visibility of dividends and income. And OSB, actually, we saw a strong operating environment, even in a weak mortgage market. And actually, that's come through, as you can see, they're all three positive contributors. So not only have they paid those high dividend yields for us, we've actually been able to deliver strong capital growth as well, because frankly, these businesses were far too cheap in the first place. Perhaps on the negative side, I should mention Smurfit Westrock. Smurfit, formerly called Smurfit Kappa, is a paper and packaging company. It was one of our strongest positive contributors in 2024, but had a very poor last year. They bought a US competitor called Westrock during 2024. In 2025, they started going through the process of integrating those businesses and understand fully all the facilities in North America. At the same time, the market was undoubtedly weak, so packaging was weak. The bottom half of the US economic growth looks strong. The bottom half of the US economy, the bottom 50% of US consumers are struggling. And that means that they're buying less things. That means you tend to use less cardboard packaging to transport things around. So the market's been weak. At the same time, we saw tremendous discipline from the US companies, both Smurfit Westrock and also International Paper, the largest player, in terms of taking out capacity and rationalize that market. Now, the shares did pretty poorly, as I said, because actually earnings were pretty lackluster last year. As we look into this year, we see the costs that Smurfit incurred in 2025 in order to merge the business together start to drop out. The synergies from bringing the businesses that come together start coming to the fore, and we see a very well structured market with very high operating utilization, even if we don't really see much in the way of recovery. So we think this business is very well positioned for this year. It's actually started, for what it's worth, it started the year very strongly. And so, although it was very weak last year, we continue to hold the stock into 2025. Talking about one which we don't have anymore, WPP. WPP within the advertising agencies looked very well valued at a very high dividend yield. And we saw strong performance from its peers, which suggested that the investments they were making would come to fruition. Unfortunately, that wasn't the case. WPP was clearly losing out to many of its peers. They actually cut the dividend at one point. We didn't think they needed to, but they did, and the chief exec resigned. So on the back of that, it's clear to us the investment thesis is no longer working, and we sold all that stock. And that's what's important to us. In Smurfit, we believe strongly that the thesis is still valid, that actually, yes, we've had a tough year, but they're very well positioned for the year ahead. So we've actually kept the position and actually added to it relatively recently. WPP, although it still looks very, very cheap, and even with the cut dividend yield, the levels of income are attractive, but the investment thesis was clearly broken. Clearly wasn't delivering as we expected, and therefore it's the right decision to sell that stock and move on. I think one of the things we can see to some extent on the negatives, you look at things like Taylor Wimpey, look at Ibstock, look at Breedon. UK domestics had a tough year. The hope that we had at the end of the hope post the election in 24 really didn't come to fruition. 2025 was another difficult year for the UK economy, as the economy and businesses had to deal with the issues of the previous budget. And as I suspect many of you will believe, the budget we saw this year, again, was not really what we hoped for in terms of positivity for the UK economy. Now, I think it's fair to say it wasn't as bad as it could have been. And we do look forward in 2026 with some confidence that things are starting to move slightly better. For what it's worth, the UK GDP in November was better than expected when it was released today, albeit 1 month can be volatile. But those domestic holdings where I will have talked about in the past, we see a lot of value in some very good businesses. Clearly, they are struggling at the moment. The one area that doesn't really come true is in the UK banking sector, where you can see NatWest on the left-hand side was a strong positive. We also own Lloyds. That's actually been a pretty strong place because they have lots of capital, they're generating strong returns, and they're paying high dividend yields. You can see not owning Barclays on the right-hand side was a reasonably negative contribution. Actually, Barclays is fine. We don't particularly like their US card business. They were impacted this week when President Trump decided to arbitrarily limit the interest rate that card companies could charge. But it's more about we prefer other businesses. We think other businesses such as NatWest, such as Lloyds, such as HSBC as well, are better businesses than Barclays. Barclays still has a very large investment banking business in Barcap, and fundamentally, we don't like those businesses. So where are we now? What are our biggest overweights and the biggest underweights in the portfolio now? If we look at the chart on the left, which is the biggest overweights, one very consistent theme here is, with the exception of SSC and Shawbrook, these are all high yielding businesses. Now, clearly, we have to generate a high level of income in order to pay the dividend that we want for our shareholders. So we tend to own more of the larger yielding stocks. In each of those cases, though, fundamentally, we believe these are high quality businesses, and that as well as paying high levels of income, they can grow into the future. Rio is the only mining stock we own. You can see on the right hand side, we don't own Glencore or Anglo American. Rio, we think, is probably the best company in the sector, best quality company in the sector. It is very exposed to iron ore, and iron ore is somewhat exposed to China construction, but they have the highest quality iron ore assets in the world. They have a very strong balance sheet, and they pay a much higher dividend yield than all the rest of the sector. So there's about 4.5%. You may have read in the press at the moment they're in the middle of talks about a combination with Glencore, and the share price reacted relatively badly. That often happens when a business is acquiring something else. But we think if you look at the mix of the combined group going forward, there's a lot of synergies, and it will be a much better balanced business than Rio or Glencore on their own. Glencore has a lot of copper assets in the pipeline. It also has a fair amount of coal. Rio has a lot of iron ore, as I said. Business together, we think, will be very well balanced. So we'll still remain positive going forward. Of course, we wait to see what the terms will be for the transaction, but we're favourably disposed at the moment. A couple of property companies, left-hand side, supermarket income REIT. I always like to say it does what it says on the tin. They own a lot of supermarkets and they pay high levels of income. And we've seen quite strong performance this year, as again, the market started to recognise the consistency of that income. At one stage, it paid an 8% dividend yield. And when the majority of their assets are Tesco and Sainsbury's supermarket, that just looked very, very attractive to us. London Metric is another property company with a 6% dividend yield that consistently grows over time. They're the type of businesses that I talked about where they're good quality businesses. They're paying high levels of income now, and that income grows into the future. It might only be going 3 to 5%, but it's consistent growth and above inflation. The two stocks on the left that have lower dividend yields, one is SSE, used to be called Scottish and Southern Electricity, or Scottish and Southern Energy. So the north of the border based electricity company. Part of the reason the yield is so much lower is that a very strong period of performance. They have a very strong pipeline of particularly renewable assets, mainly wind farms in North Sea, but also a strong pipeline of investment required in their distribution network, where the returns are regulated, and we're very positive on that business as well, albeit the stock has done quite well. As I said, the dividend is that much lower. The other one is Shawbrook. Shawbrook is another specialised UK lender, primarily to sort of small and medium-sized businesses. This was an IPO last year, so you may have heard for a long time about the dearth of IPOs, in initial public offerings in the UK market. Shawbrook was a very successful IPO last year, and the shares performed very, very strongly last year, which is actually the reason it's in the biggest overweights in the top 10, purely by reason of performance. And we see doesn't pay much in the way of income now because it's growing very quickly, but we see the prospect of strong capital growth and strong growth in their balance sheet in the future years. In terms of the underweights, Unilever is clearly the biggest. We continue to struggle with the sort of food companies. They're struggling to drive growth. They put up prices a lot during COVID, and now they can't cut prices without hitting the top line. But they really need to cut prices in order to drive growth. So they're a difficult place to be, and we think that will struggle going forward. I've talked through some of the others. Haleon, a similar situation. Unilever, albeit it's not food, it's a non-food business, but in that CPG space, it's quite tough. 3i, the investment company, worked very well, not only for us last year because of a weaker performance in France, but we're watching that very closely because fundamentally that's a very good business that may be having some nearer term hiccups. Obviously, if anyone has any questions, any of these at the end, I'll be fantastic to hear from you. We have a few examples here, which I'm going to go through very quickly in the interest of time. Smurfit, I've talked about. Again, we think this is a business which is very well placed for the year ahead. The free cash flow yield of around about 10% for next year. Dividend yield of well over 4%. So again, dividend yield, synergies coming through. We believe this business will drive growth in the future. We've known the management team a very long time. They are, I believe, the standout management team in the sector, and they've taken a poorly performing US business and looking to really improve that, but only in line to the returns they generate in Europe and Latin America already. So again, very positive on that one still going forward. Rolls-Royce, actually, they do pay a dividend again now. They announced the last set of results, I think, going back to dividend yield. And what we've seen here under the still relatively new CEO is a very strong period of performance. They turned this business around. So this has been an incredibly strong performer, added a lot of value for our shareholders. But we still think when we look at the engine market for wide bodies, which is where Rolls-Royce is mainly positioned, the future looks very strong. Rolls also has a nascent position in small modular reactors, so small nuclear reactors, where they're one of the leading proponents. and that can drive growth for many, many years, if not decades going forward. So still well positioned despite its very strong performance. BT, high dividend yield, investing very heavily in fibre. That means that's consuming a lot of cash. The next year or so, that investment starts to peak, and then cash generation after that will be very, very strong. NatWest, I talked a little bit about the UK banks. That this one again, we bought this very well at the time of the Nigel Farage scandal when the shares were very cheap. So it's been a very strong contributor for us, but still pays over 4% dividend yield, which we think will grow into the future. So it's still pretty well positioned at the moment. So looking forward, I've talked a lot about what's happened. I've talked a bit about the stocks we own already and why we think they'll be positive going forward. But what do we think about overall in terms of maybe our sentiment towards the market and what we think can happen? Well, we said last year at least we had stability because we'd had the election. We're looking forward. As I mentioned earlier when I referred to the last two budgets, the government has not perhaps delivered certainly what business would have wanted, certainly what many investors would have wanted, particularly in terms of tax rises and increased government spending. But at least we do have stability. So the Labour government, and we can discuss perhaps leadership going forward, the government will remain for another 3 years. So we have knowledge that we will not have the turmoil perhaps we're seeing in some of the other European countries. And we have had those tax rises in the November budget. So again, at least we have some visibility. Businesses can now look forward with some certainty as to what's the backdrop under which they're investing. We've talked before that the government has had tried a lot of supply side reforms, for example, freeing up land for more house developments. That takes time to come through, but there is some evidence those supply side reforms are starting to come to fruition. We've had two of the UK house builders report this week, and they've both talked about land supply starting to loosen up. But it is a slow process, and it will take time and will really impact during 2026 and probably the second half. We still believe the UK market, despite a 24% rise last year, remains very attractively valued, both in absolute terms, but also certainly relative to other markets. So we're still very positive on the UK. As I said earlier, one of the reasons our holdings in Europe are relatively limited at this point in time. And this is increasingly being recognised by corporate buyers and private equity. It doesn't seem to be a week, perhaps even if a day goes by now, where we don't see more rumours of companies being bid for, as corporates recognise that actually they can buy business in the UK, they can gain some high quality business at pretty low prices. So that inevitable is support for market. We had another interest rate cut before Christmas, probably not many more to come, but still more to come. And we've actually fallen quite a long way, really, from the start of the interest rate cycle. So lower rates will help sentiment. The UK 10-year gilt hit a sort of a near-term low just yesterday. So mortgage rates are coming down. That will help the housing market. And as we know, housing in the UK is a massive driver of both sentiment, but also propensity, I should say, sorry, I can't get my words out, to consume as well, either because you need to change your house when you move or because confidence is higher. So the housing market improving this year is crucial. We're not expecting a massive recovery. We are certainly expecting a better 2026, 2025. So with that sort of backdrop, we believe that the CT UK High Income Trust is very well positioned. We're going to provide our investors a high level of income. Whatever happens, that level of income we believe will grow as we have done for the last 14 years going forward. So you know that your level of income will grow into the future. And we believe, despite, as I said, the strong 2025, there's a strong potential capital growth as well. The businesses that we buy have high dividend yields, not because they're poor businesses, but because they're either out of favour or they're unrecognised, or we have a much stronger view of their future, perhaps the market any way, shape, or at any point in time. So we think we're very well positioned. We think we can deliver strong returns going forward, and we're very confident to look through to 2026. I will pause there, as I've spoken pretty much non-stop, I think, for 29 minutes. And I'd love to answer any questions that you may have going forward.
Thank you, David. Yes, thanks for the summary. We'll ask you to speak a little bit longer if you don't mind. So we'll ask a few questions, and if you've got any questions, please put them into the chat room, and I will send them over towards David for a response. But to start with, I mean, income is obviously very important for the trust, very important for shareholders. And it's great to see both the FTSE All Share, which is the benchmark, and also the NAV go up quite considerably last year. But what this does for new buyers, for new investors, it reduces the dividend yield. So I think the FTSE All Share yields around 3.1, 3.2% at current levels. And of course, with the share price trading up where it is, the trust trades at a yield of around 5%. What are your thoughts on dividend growth for the index, but more primarily the trust? Are we going to be able to boost that as a percentage of net assets to sort of maybe 5.5%, or do you think that dividend growth will be curtailed a little bit in 2026?
I mean, I expect more dividend growth from the market as a whole. I wouldn't want at this stage to put a number on it. We're just about to get into the results season, and that will give us a much clearer guide as a company's level of confidence, because they'll pay this year and they give us a guide going forward. But definitely, I expect growth in that dividend going forward. I would expect that we as a trust would be able to continue growing that dividend, and that's a clear objective for us. Obviously, the dividend itself, what we pay, it is subject to the board's decision. So it's be wrong of me to preempt that. But certainly, I would expect that we will continue to deliver at least the growth we've done in the past going forward. In terms of the absolute amount, of course, you're right. When we have that level of strong capital return, the yield by its very nature comes down, but it's still 5%. So relative to what you can get in the bank account, perhaps relative even to corporate bonds, certainly relative to the market, I believe we're still delivering a very attractive and high level of dividend income. And again, that level of income will grow. So again, wouldn't really want to put numbers on it at this stage, but certainly we expect and believe we will grow the dividend for our investors into the future.
Excellent. And you touched on gearing a little bit. I think from the fact sheet, the gearing is around 11.5%. How does that compare to historical levels and where you can go as a maximum?
So it's pretty much where it's been since I've been running the trust for the last 2.5 years. I think one of the key advantages and the key benefits of the investment trust structure is the ability to use leverage to add return to your clients. So what we don't try and do is time the market. I don't think it's our skill set. Our skill set is buying good companies that pay good dividend yields. And as long as we can find businesses that we think are attractive, then we'll utilize that dividend yield. So it's around about where we've been. We have the ability to borrow up to, I think it's 20 million, which would be about 13% dividend, where 13%, leverage, where the value of the trust is at the moment. And we'll always be there or thereabouts. That's certainly the expectation I have at this point in time. But yeah, I believe that we should be structurally leveraged because it's a key positive for the structure as a whole.
Yeah, very true, very true. So notwithstanding the great moves we've had in the UK last year, how do valuations compare in the UK now compared to Europe, USA, maybe Asia? I think about 12 months ago, you were suggesting that the market looked incredibly cheap. Now we've had that great move last year. What are your thoughts with valuations compared to the other equity markets in the world?
Yeah, I mean, I think in absolute terms, we're probably not incredibly cheap anymore. It's difficult to say that when you've gone up 24%. We are still cheap though. And as much as the market itself is cheap, when we look at the companies that we invest in, again, we still see very high levels of income growth and very attractive valuation. So certainly relative to the US. In the US, if you think about it in dollar, European markets and UK market in dollar terms, we had an even stronger year last year because of the weakness of the dollar. And that's something actually we're thinking about quite a lot in terms of our investee companies. It's clear a lot of the larger companies have reasonable dollar businesses, so that's something we need to consider. But to us, the UK still looks very attractive. Now, the UK does grow more slowly than other markets, so one can argue it should always be a bit cheaper. But we still think the differential is too extreme. At the same time, the UK is a relatively defensive market. So yes, we don't have the exposure to AI and data centers and all of that everyone else has, and that's certainly been a detriment over the years. But it also means we've not had those very high booming and volatile share prices. So the UK has the benefit, we believe, of much steadier growth, and that's one of the reasons why the UK stocks can pay very attractive dividend yields.
Lovely. So it all sounds very positive, but let's maybe just have a quick check on the negatives. What do you think the biggest risks are for UK equities, and hence what could affect the portfolio in the medium term, in the next 12 months or so?
And I think that the biggest risk is the risk we can't really analyse, which is geopolitics, because frankly, who knows what's going to happen next, depending on what President Trump does or doesn't say. I would say, again, in any geopolitical driven issue around markets, the UK market itself will always be relatively defensive. So while inevitably there will be a hit at times, the UK will do, we believe, better than the markets. And history has showed us that what we should do at such times is not panic, but continue to do own good businesses, because they continue to provide returns to the future. So that's the first one. That's unanalyzable. Inflation is still a risk in the UK. It's a risk to consumers, because consumers don't feel particularly well off. It's also a risk to cutting interest rates. So I think that's something we need to watch. And I talk about geopolitics, but UK politics is still a risk. I think we are in the slightly odd situation where, despite her massive unpopularity, Rachel Reeves is our best or least worst option at the moment, as is Keir Starmer. The risk would be if the Labour Party decided to change leadership and move to the left, that would be seen very poorly by equity markets, but particularly by bond markets. Now, bond markets are their own break. They will stop anything too crazy happening. But those are things we need to think about. Fundamentally, the UK is in a pretty decent place. Unemployment is rising a bit, but not much. Real wages are still growing, which is an issue for inflation and for a lot of businesses, particularly in hospitality, as we hear a lot about. But that is helping consumers. Interest rates have come down and are coming down. So affordability in housing is improving. And growth, as I said, is okay. So the fundamental backdrop is not super strong, but it's actually fundamentally positive. And that's what gives us the confidence to look forward and look through inevitable volatility. There will be volatility this year. We want to see that as an opportunity to add to good business at good prices.
Thank you. You mentioned briefly about 2025 and the fact that the NAV slightly underperformed the FTSE All Share. The question is, can you explain the factors behind the underperformance and how the income-focused approach influenced results?
I think I wouldn't say the income approach per se had an impact. If you look at the slide with the biggest contributors, a lot of those are high income yielding stocks. One of the areas which we have found attractive and still do is the exposure to UK domestics. So the house builders, the breeders, the brick makers, the banks which have worked, some of the retailers. So we think they're very attractively valued. We think that the prospects are good. We have to build more houses. We're really exposed to that area we believe has a strong future, but that's clearly not worked. And I think confidence post the 2024 budget, certainly concerns going up towards 2025, where there seemed to be a leak every day about what taxes the government were going to put on. And we've seen that Dunelm, which is one of our holdings, reported today and talked about a very weak Christmas, confidence being very low. So the pre and post budget period. And that's been one of the biggest detriments to performance last year, that the investment in that space. We have cut it back a bit because clearly it's taken a lot longer than we'd anticipated. So we have smaller holdings we had historically, for example, in the house builders. But on the long run, these businesses are trading at or below NAV. They have net cash on the balance sheet and strong dividend yield. So we think we're getting paid to wait for those. And the other big one is Smurfit. As you can see, Smurfit alone, if one were to think everything else was equal, Smurfit more than accounted for underperformance of last year. As I said, very strong the year before. We believe very well positioned this year, but those are the key reasons for the underperformance.
We have a question here about National Grid. Why do you not hold National Grid, and what is your opinion on it?
So I have nothing negative on it. We have held it in the past. It did very well when we sold it. The yield is attractive without being super attractive for a utility. We were holding it or bought it when they did the capital raise in order to fund the pipeline. So they've got a very long multi-year, probably multi-decade investment plan into infrastructure, into the grid, because of all the new electricity generation. So I have nothing against it. We just saw better opportunities elsewhere, both for income and for growth.
Fair enough. And a final question. Thank you for all your questions, listeners. We'll close the session with a final question. M&A has obviously been very prevalent in the markets to date. Do you see that continuing in 2026? And what are your thoughts about the IPO market opening up for maybe a few more new issues coming to the market to replace some that we've lost in the last couple of years?
I think M&A will definitely continue for perhaps a few reasons. Companies are struggling a little bit out there, unless you're in AI in the US, for growth. So one of the ways for growth is acquisitions, and generally most businesses have pretty strong balance sheets. So I think that's a positive. Private equity, much talked about, but they have very strong, had very strong asset raise in the last few years. So they have a lot of cash to spend. They like to spend it because they can't generate returns, and they often can't get paid unless they actually invest the money. So there's a definitely desire on private equity to invest. And at the same time, valuations remain very attractive in the UK. So unless we see I think a big recovery in valuations, which would be great because the stock market would have gone up a lot, I expect M&A to continue, particularly in the UK and across the market cap spectrum. Probably more focused at the small and mid cap end because there are more buyers of those size of businesses, but I can see it happening across the spectrum. In terms of IPOs, I mentioned about private equity having raised a lot of money and they need to spend. At the same time, private equity companies have a lot of investments from previous years where they need to sell on. The funds have a finite life normally. The longer the life of the funds goes on for, the lower their returns. So there's definitively a desire for a lot of these investment companies to realize returns. And one of the ways to do that is to sell to each other. But obviously one of the clear ways is IPO. So we expect a big pickup. We've seen very little as the last, probably 3 or 4 years. There's a big pipeline out there and market conditions look favorable. So yeah, we definitely expect to see a few more. And that's good because the more we get, the more we can pick and choose which are the best quality ones for our investors.
Lovely, thank you. We'll end it there, but if I can just ask you for final comments or summary, and then we'll hand back to the moderator.
My final comment would be that many investors look at a strong year like last year and go, well, that's we shouldn't expect very much this year. And I have no ability to say, well, the market will be up, down, or different at this point in time. What I would say is I think we're pretty well positioned. Growth isn't great, but it's okay. The consumer, which is the strongest part of GDP, is despite everything we read, actually in a pretty good shape. What we're lacking is a bit of confidence. Interest rates have come down. We think will continue to come down a bit more. And there's lots of really good UK companies out there. So we look at the year ahead, despite a strong year last year, with a lot of confidence that we can provide both the high level of income, but good capital growth for our investors as we look through 2026.
That's great. Well, thank you very much for updating investors today. Could I please ask investors not to close the session as you now be automatically redirected to provide your feedback and all the management team can better understand your views and expectations. On behalf of the management team of CT UK High Income Trust PLC, we'd like to thank you for attending today's presentation and good morning to you all.